Today, the Japanese yen crossed a threshold that sent shockwaves through currency markets. It fell to 161.98 per dollar, its weakest level since December 1986. That's not just a round number, it's a 40-year low. And what makes it extraordinary is not the level itself, but what Japan has done trying to stop it, and how little it has worked. To understand how we got here, you need to understand one simple but powerful concept: the interest rate gap. The United States Federal Reserve currently holds its benchmark rate at between 3.5% and 3.75%. Japan's central bank, the Bank of Japan, just raised its rate to 1% on June 16th, its highest level in nearly 30 years. 1% sounds like progress, but against America's rate, it still leaves a gap of roughly 2.5 percentage points. That gap is the engine behind what traders call the carry trade. Here's how the carry trade works. Investors borrow in Japanese yen, which is cheap because rates are low. They then take that borrowed money and put it into higher-yielding American assets. Treasury bonds, equities, anything paying more than what they borrowed at. The difference in yield is essentially free profit, as long as the yen stays weak. And the yen staying weak is precisely what keeps the carry trade spinning. This trade has been running for years, but right now it is running at extraordinary scale. Speculative short positions on the yen have reached their highest levels in 9 years. There is an enormous wall of money globally that is betting against the Japanese currency and profiting from its decline. Tokyo has not sat still. Between April and May alone, Japan deployed a record 11.73 trillion yen, roughly 73 billion US dollars, buying its own currency on the open market to prop it up. Then, on June 16th, the Bank of Japan raised rates to that 30-year high of 1%. Finance Minister Satsuki Katayama has repeatedly warned that authorities are prepared to take, in her words, bold action against excessive speculative moves. She even met with U.S. Treasury Secretary Scott Bessent, and both sides agreed to coordinate if necessary. And yet, the yen barely flinched. As one analyst put it, intervention without changing the underlying monetary policy is like tapping the brake while keeping your right foot firmly on the accelerator. Why? Because the forces pushing the yen lower are bigger than Tokyo's firepower right now. The dominant one is the Federal Reserve. On June 17th, new Fed Chair Kevin Warsh held his first policy meeting. Markets had hoped he might signal a pivot toward easier policy. Instead, he doubled down. The Fed's projections showed nearly every policymaker expecting rates to stay flat or go higher before year-end. Only a single official penciled in a cut for all of 2026. Warsh eliminated traditional forward guidance entirely and delivered a blunt message. The Fed has missed its 2% inflation target for 5 years, and that changes now. The Wall Street narrative has since shifted to high for longer, and that keeps the interest rate gap and the carry trade fully intact. Adding pressure is the fact that Japan is one of the world's most energy-dependent economies. Over 90% of its oil imports pass through the Strait of Hormuz, the same waterway that has been disrupted by the U.S.-Iran conflict since February. Higher energy prices hit Japan directly and disproportionately, forcing the country to buy even more dollars to pay for imported fuel. That structural demand for dollars is another relentless weight on the yen. The critical question now is what happens next. The key level to watch is 161.96, the exact point where Finance Minister Katayama has publicly flagged intervention risk. The yen has now broken past it. Traders are on hair-trigger alert. When Japan last intervened aggressively in July 2024, it worked briefly, but the yen gave back every gain within weeks. And in August 2024, A surprise BOJ rate hike triggered a carry trade unwind so violent that Japan's Nikkei index fell 12% in a single day, and global markets shook. That is the hidden danger in this story. The yen carry trade is not just a currency story. It is a global liquidity story. The moment Japan meaningfully closes its rate gap with the US, or the moment a geopolitical shock triggers a rapid rush back into yen, the unwind of those speculative positions could ripple across stocks, bonds, and risk assets worldwide. For now, the yen sits at a 40-year low. The carry trade rolls on, and the world watches to see whether Tokyo finally has the tools or the nerve